Today we have speaking is Aaron Fragnito. Aaron Fragnito is a senior managing member and co-founder of People's Capital Group. Aaron is the host of New Jersey Net Real Estate Network, the Passive Cash Flow Podcast, wrote and taught real estate entrepreneurship at Rowan University, all while being a full-time real estate investor. Aaron has built an eight-figure real estate portfolio and is well known in the real estate market throughout New Jersey. Aaron has completed over 300 real estate transactions. He has helped over 100 people invest in real estate while raising over 10 million in private capital. He has been a guest on over 60 podcasts and also presents live webinars on his own and on a monthly basis. Aaron enjoys speaking at events, often to educate people about real estate investing. Aaron holds a BA in business management with a concentration in entrepreneurship from Rowan University. Aaron focuses on building strong relationships with his clients, understanding their goals, and helping them execute their goals into reality. He has 25 million real estate assets under management, 150 rental units, helped 100 plus people invest in real estate, and has closed more than 50 million in real estate transactions. And with that, I'll turn it over to Aaron.
Thanks, Charles. I think I need to update my bio there. It's a little outdated, but glad to connect here and present to your group here. I'm going to share my screen and we'll get right into the topic of the evening. Oh. I haven't done Google in a while. I'm usually used to PowerPoint here. Let's see. How do I present? Hold on a sec. Okay. Let's see the presentation here. Is that correct?
Yes, we can see it.
Okay, great. So, actually, that's the right one. Okay, excellent. All right, thanks a lot, Charles. So my name is Aaron Fragnito. I am co-founder of People's Capital Group. Been in business over 10 years here. So we're strictly focused on New Jersey. We buy apartment buildings throughout New Jersey, and we also have a small debt fund that does fix and flips and smaller multifamilies. Right now, we're focused on anywhere from 50 to 400 plus units throughout Jersey right now. We're getting into ground up development a lot, which I'll touch on tonight also. And the topic of the evening is building wealth, strategies for acquiring and enhancing apartment investments. All right, let's get into it. Quick disclaimer, this is not a solicitation for funds, tax advice, or legal advice. Okay, here's the appendix tonight. So why apartment buildings? I'm going to talk about one of the reasons we focus on residential housing and apartment buildings, and three investment strategies for investing in apartment buildings. Key investment concepts, kind of a 101 of getting into commercial real estate and specifically residential multifamily housing concepts and terms you want to know. I'm going to talk about raising capital because that's a pretty important piece of the pie. It's allowed me to build my portfolio aggressively through the years. I'll tell my story a little bit and how quickly you run out of money when you start buying real estate. So you got to learn how to raise capital, and that's a big part of it. We'll talk about current projects and upcoming projects as well, because that'll help you understand how we buy and reposition apartment buildings. So why apartment buildings? So we like the steady stream of rental income. We find that generally apartment buildings have very high occupancy and low vacancy. We find that there's a shortage of housing here in New Jersey, and if you can own it and manage it properly and keep your buildings well maintained and well managed, then you tend to have a nice client base, a tenant base that's going to continue to pay their rent on time. People need a roof over their head, so it's a commodity. We also like the self-storage space as well, but self-storage, for example, is an area where it could take 2 or 3 years to lease up your building. I was just underwriting a 790 unit self-storage building in Lake Hopatcong, New Jersey. And, what killed the deal, one of the reasons why was that it took 3 years to lease up the building and get to full stabilization. Where with apartment buildings, we're underwriting a number of buildings right now. We're looking at 420 unit in Jersey City, New Jersey. And we're estimating about a 12 to 18-month lease-up period. I think 12 is quite doable. So our developer and management company appear to be confident with that number. So we can lease up multifamily housing very quickly. We can keep it leased. Rent demand and therefore rental prices of multifamily housing tend to be pretty darn strong here in New Jersey and North Jersey and really most parts of the country. So obviously, a lot of people do multifamily. It's a very popular type of asset class to invest in. And I think because of that, you have to be a little more savvy on the buy end, and you have to really know how to structure a deal wisely. That's one of the reasons we're getting into ground up development right now, is because it's tough. It's tough to find a discounted apartment building for a good price that needs renovation and repositioning to improve the property. Interest rates are definitely a hamper on that right now. So that is a damper on that. So that's something that we're really challenged with as far as buying existing assets. And that's one of the reasons we're getting more into ground up development of apartment buildings. Scalable leverage and appreciation. So you have forced appreciation in apartment buildings. That means things you can control. That is things like renovating a unit, making it a more desirable unit, renovating the building itself and the amenities and the exterior of the building and the curb appeal of the building, improving the management of the property so that tenants have a more enjoyable experience living in your communities and your buildings. And that is called forced appreciation. Those are all ways you can controllably increase the rent roll on a building. Right now, there's different rent roll laws you have to watch out for. In New Jersey, we try to steer clear of cities that have ridiculously restrictive rent control laws. But we do find that a number of cities in New Jersey are pretty easy to navigate the rent control laws if you understand them and can work within them. So you have forced appreciation, which is important to understand, renovating units, improving your communities, improving your buildings. They're making them nicer places to live with better amenities. And then you have natural appreciation. Natural appreciation is going to be more focused on essentially macroeconomic forces like inflation, pushing the value of your real estate up, inflation, which also pushes rent up over time, and interest rates going down, property values should go up, right? So natural appreciation it's not always appreciation, right? You could have natural depreciation over the last year or so with interest rates going up. But in general, if you're buying in high demand markets, you're managing your real estate well, you could achieve a combination of forced appreciation where you're actively repositioning apartment buildings and forcing value into the asset, and then natural appreciation, because most of the time inflation is going to push your real estate values higher, your rents higher over time, especially if you're buying in the right markets and managing and maintaining your assets the right way. Tax benefits, right? So we are focused on tax depreciation as well, and recognizing all the tax benefits of real estate in general. We like to pass these tax benefits down to our passive investors. That includes tax depreciation. You can write off your cash flow with tax depreciation. In fact, you can front load your tax depreciation through a cost segregation study, and that allows you to take advantage of maybe 40 to 50% of your tax depreciation within the first year of buying an asset. So tax depreciation is a great tool. A cost segregation study is a great tool to front load your tax depreciation. And of course, you have all the operating costs as well of operating and managing real estate as well that we use to write off our income. You have interest as well, and other tax benefits of owning real estate, where it's one of the most tax advantaged asset classes in the world that's available. And that's why about 70%, I believe, of billionaires' wealth, somewhere around 60 to 70% of billionaires' wealth is often held in commercial real estate. And that's a very popular way to hold and preserve your wealth. And as we work with family offices and high net worth individuals, we find that many of them enjoy preserving their wealth through the tax benefits of real estate, especially multifamily housing, because it holds consistent demand and consistent cash flow. Okay, let's get into 3 investment strategies for investing in apartment buildings. So first of all, you can do it yourself. Okay, we got started. My business partner, Seth Martinez, and I buying a 6-family in Newark, New Jersey, 2012. I stapled a "We Buy Houses" sign to a telephone pole. I think it was August. I was wearing a suit and tie for some reason and running around and stapling signs to telephone poles. And that worked. That worked back then. It doesn't work all that well right now, but it worked pretty darn well back then. And we bought a 6-family in Newark, New Jersey for $220,000. We put about $60,000 of investment into it. Now, we raised some capital, but I also acquired a partner, Seth Martinez, at the time, my partner to today, my business partner, and he had sold a medical billing company, so he was flush with cash. I was a realtor. I was learning how to source opportunities. I did a lot of short sales, REOs, investor deals, and of course, ran around and stapled signs, telephone poles that said, "We buy houses." So that allowed us to source a pretty good deal. 6-family, Newark, New Jersey for $220,000. If you know that market at all, you'll know that that's a great deal. So it was also a different era. So I can't really compare it to today's prices. Recently appraised, I think our last refinance appraised for like 790. So we bought it for 220. We put in about 60,000, spruced it up, leased up the remaining 3 units. And then we refinanced our money back out. We used a hard money loan to buy it. Okay, we put down about 20%. We used a hard money loan to buy it, high interest, high fees. Put some cash into the property ourselves. And although we may have borrowed some of that from the hard money lender as well, we refinanced all of our money back out. Okay, 220 purchase, 60,000 renovation cost, and then appraised like about a year later for somewhere around 400,000 or the high threes. And we were able to essentially take out about 70% of that new value of the property because we increased the rent roll of the property. And by increasing the rent roll of the property, we've increased the value of the property. Because as we'll get into in the next slide, commercial real estate, the value of commercial real estate is based on the net operating income divided into the cap rate. The bottom line is that every dollar you increase the rent roll by, it increases the value by an exponential amount, even greater than that dollar. And so that allowed us to increase the value. We forced equity into the property. We forced the value of the property up. We renovated units. We leased them up for fair market value. We renegotiated current leases with existing tenants. And we refinanced our money back out 100% in about a year. And we went on to buy more. We ran out of money pretty quick. We had to learn how to raise capital. And raising capital has been, I'd say, the pinnacle of my career. It's been one of the most challenging things to do. When you're raising private capital, but you want to really scale up and buying apartment buildings, it's very important to understand how to raise private capital. So that's doing it yourself. We developed a management company over the years. In 2015, after firing 2 of them, one was stealing money from us. So management companies ended up being pretty difficult to manage. And we ended up managing our properties ourselves and developing our own management company. We have some great employees in that company. It's helped us create the brand we have today. And doing it yourself is an interesting way to invest in real estate. It's expensive. You lose money, you make money. But any type of, even flipping houses, my first flip, I lost $7,000 on. I consider that a success because a lot of people pay $27,000 for education courses or whatnot. So, you know, doing real estate yourself is a full-time job if you want to do commercial real estate or even flipping houses if you want to do it right. So because of that, real estate investment firms such as real estate syndications, when you're pooling capital together amongst many investors, and that allows people to invest passively. For example, the last building we bought in Bayonne, New Jersey, we had 42 people invest in that building. Some invested $100,000, some invested $300,000. And those investors are passive investors. So they get monthly updates telling them exactly what's going on with their property. They get quarterly financials as well, a balance sheet, profit and loss statement, a distribution statement, along with a quarterly cash flow distribution, ACH deposit right to their account. That's what passive investors, right? You can do that on Fundrise. You could put $1,000 into an investment on Fundrise, something like that, right? There's all these crowdsourcing sites now these days, and you can invest passively in actual brick and mortar real estate, right? There's big real estate syndicators out there like Grant Cardone and big flashy guys that drive around in jets, and you can invest in them as well. So there's different options to invest. You can invest in a local real estate syndication like People's Capital Group, and you can invest in nationwide syndications as well that have billions of dollars of assets. Then you have active partnerships. Okay, an active partnership is going to be more similar to a joint venture. A joint venture means you're pretty much investing alongside an active investor. You're going to be a little more active than a passive investor, but you can also structure a joint venture. So you have one person essentially doing the legwork and the boots on the ground and managing the management company, managing the contractors, running through 400 bad deals to bring you one great deal, running the underwriting for hours on end to make sure the numbers check out on the opportunity. And that active partner can team up with somewhat of a passive investor, but this could be a joint venture where you're still somewhat involved in a decision-making position, okay? See, when you're a passive investor and you're investing alongside 42 other investors, like in our Bayonne property or other apartment buildings we've purchased, you're a passive investor, you're a non-voting member of the LLC, okay? That means you don't choose what tenants we lease to or what color we paint the hallway. All those little nitty-gritty details of managing a property day in and day out, getting different quotes from contractors. We're responsible for all that, and we report back to our investors. We have a fiduciary responsibility to report back to our investors and be as transparent as we possibly can and use the invested capital in the exact way we propose in our offering memorandums and private placement memorandums, which the investors review prior to making an investment. That's a passive investment, though. You're investing completely passively and you're trusting professionals to do the right thing with your investment capital. It's a very common way for people to invest who are busy, who work 9 to 5 or even more. We have doctors, lawyers, C-suite executives, teachers, plumbers, electricians, realtors, all types of people that invest with us in and out of the real estate industry all around the country, but primarily New York, New Jersey area. It's because we focus strictly on New Jersey properties. But on the other side of that, the more active partnership you can have, the joint venture, you can be involved in decision-making. You might say to your partner, I don't really care what color you paint the hallway or how you underwrite the tenants. You're good at that. I trust you to do the right thing, but I want to vote on the exit strategy. If we refinance or if we sell the building once it's stabilized, I want to be able to vote on that. I want to be able to have a say on which bank we go with, the terms we get on the refinance. I want to be able to review the purchase offers when we go to sell the building and say yay or nay on the purchase on the buyer's offers. I want to be somewhat invited into making decisions on large change orders on the construction. Anything over $10,000 in a change order from an initial proposal from a contractor, I need to sign off on. Okay, you can have little rules like that within a joint venture that protect your interests with more decision-making capabilities. Okay. However, chances are, if you go to a real estate syndicator who's done hundreds of transactions and worked with hundreds of people and built a business on helping people passively invest in real estate, and you say, hey, I want to call the shots, they're going to say, sorry, buddy, that's not our business model. So generally, joint ventures are done with smaller investors that are kind of getting started. I got started with joint ventures, right? I gave decision-making to my investors, but as I grew and had 6, 7, 8, 9, 10, 20 investors in a deal, these are people that have nothing to do with real estate. They're not real estate experts. They're experts in what they do. They might be surgeons. They might be incredibly sharp in what they do, but they're really not qualified to manage and reposition apartment buildings. If they were, they'd be doing it themselves. So often we find that passive investors understand that the active managers have their role. You're hiring them because of their expertise. And that could be a great position for many investors and just enjoy monthly updates, quarterly financials, quarterly deposits to your bank account. And that's a great way to invest in real estate for the majority of people who want to get invested in real estate. Okay, but you can do the joint venture at more active ways as well. Now, if you want to be completely hands-off, even more so, you have REITs. Okay, publicly traded REITs are stocks backed by real estate. Beware, you do not own real estate investing in a publicly traded REIT. You own a stock that's backed by real estate. You don't get the tax depreciation. You don't get the benefits of a slow-moving asset class where you're not going to lose your value overnight. For example, if you owned a bunch of REITs that own office space, and when COVID hit, those REITs dropped by like 80% in like 3 days, right? Now, office buildings, the real true value of office buildings didn't drop by 80% in 3 days. That's not how commercial real estate works. It moves so much slower than that. It's like a steam train. But the REITs themselves, the investors recognized that office was going to get hit hard, so therefore the stock plummeted. So the benefit of investing in a REIT, a publicly traded REIT, is it's quite liquid. You can buy it today and sell tomorrow. You can buy it tomorrow and sell tomorrow. So there's huge benefits of investing in REITs, that it's very liquid. Okay, it's a stock backed by real estate, and REITs can do great. They can pay 8% dividends. They can grow in value. They can also drop in value as the market goes up and down. Many people own publicly traded REITs. They're one of the largest investment classes to invest in real estate. Then you have privately traded REITs. Okay, this stands, REIT stands for Real Estate Investment Trust. So privately traded REITs are a little more similar to a passive investment in a syndication. You can get tax depreciation passed through in some REITs. Other REITs don't allow that. Privately traded REITs are often for accredited investors only, meaning you have a net worth of $1 million, not including your primary residence, or an income of $200,000 individually, or $300,000 including your spouse. That's an accredited investor. And most funds, passive funds and privately traded REITs, only allow for accredited investors. So if you're not quite at that income threshold or wealth threshold, right, million net worth, not including your primary residence, or 200,000 individual income, or 300,000 with your spouse, then you may qualify for different funds as a sophisticated investor. And a sophisticated investor is someone that has experience investing in real estate and has the minimum investment amount plus excess income and savings. So we'll get into that a little more towards the end of our presentation here. By the way, my friends, in the chat, if you want to type any questions, we will be going through those at the end. But I encourage questions as we go along here. And I'm moving a little slow here. Let me speed up. All right. So key investment concepts, like cap rate. It's important to understand what a cap rate is. It's your net operating income. Okay, your net operating income is your gross revenue minus your expenses. And then you have your net operating income. You divide that into your purchase price. Okay. Now, a cap rate will change per market. Okay. More desirable, newer, Class A type of real estate. Okay. Real estate goes into 4 classes. Class A being the most desirable, the newest, the most beautiful types of real estate, and Class D being the least desirable, the oldest, the more inner city areas, more crime-ridden areas tend to be Class D, Class C, and then as you get in more desirable areas, you tend to have Class B, Class A, newer, nicer amenities. Okay, newer construction tends to be Class A real estate. So you have different levels of real estate, A, B, C, and D. It's important to know the difference. I got started in D real estate, and I recognized a lot of challenges there. It tends to pencil out better on a spreadsheet than it does in real life. And our sweet spot is generally buying Class C plus buildings and transitioning them into a solid B, or even building Class A real estate. It's a great way to build wealth in real estate as well. So you want to understand your cap rate for a market. Okay, your cap rate is a quick number to understand. Capitalization rate is a quick way back of the napkin to understand what you should be or what a property, what you should pay for it. Okay, you can do the calculation a few ways. You can say to your realtor, hey, what's the cap rate for Newark, New Jersey? Say, okay, the cap rate in Newark, New Jersey for Class B properties is 6%. Okay, and you can say, well, okay, that's good to know. Thank you. I'm glad to know, cap rates fluctuate through markets. Okay, different, more desirable markets have lower cap rates. Less desirable markets have higher cap rates. Okay, downtown Manhattan's going to be at like a 4.5 cap these days, where downtown Newark's going to be at like a 6 cap these days. Okay, as rates go lower, cap rates also go lower. Okay, well, that's a whole different topic. But the bottom line is your cap rate. You got to know the cap rate for your market. Focus in on a market. Learn the cap rate. Learn what buildings, what type of cap rate a building should have. An older, less desirable building will have a higher cap rate. Okay. So let's say you're looking at a building and your realtor says, hey, for a building like this, you're going to want to use a 6 cap. Okay, great. You go to the rent roll, you look at the net operating income, it's $1 million a year. Okay, after your gross collected rent minus your expenses, not including your debt service, that gives you your net operating income. So you take your net operating income and you divide it into your cap rate, and that's going to give you your purchase price, how much you should pay for the property. Okay. You can also take your net operating income and divide it into your purchase price, and that'll give you the cap rate of that building. Okay, what cap you're buying it at. So if you know the purchase price, you know the NOI, you can come up with a cap rate, and that cap rate might be very high, meaning it's kind of a good deal, or the cap rate could be kind of low, meaning it maybe it's not a great deal. It's overpriced. Okay. Now, this doesn't tell the whole story because your net operating income on a building often will not be what it could be. So you have pro forma net operating income. That's assuming the units are rented out, the building's stabilized, it's banging on all cylinders. You did the things you need to do to make it the best building it can be. And that's your pro forma net operating income, right? And that's going to give you, if you take your pro forma net operating income divided into your cap rate, that's going to give you what you should be paying, what the building should be worth when it's stabilized. Okay. But if you take your net operating income and divide it into your purchase price and you get a cap rate that's very high, you might say, wow, this is a great deal. Or you get a cap rate that's very low. You might say, oh, this is not a great deal. So there's different ways to play around the cap rate and the calculations of a cap rate. The bottom line is those are 3 variables you need to understand. What's the cap rate you want to be paying in a market? If a broker sends you a deal, he says, I got a great deal. It's a 4 cap in downtown Baltimore. You might say, ooh, that doesn't sound like a great deal because everyone's buying properties in Baltimore at a 6.5 cap. Okay. And your broker's trying to sell you a deal at a 4 cap. That's an overpriced piece of real estate. I know that right away by one calculation, the cap rate. Okay. But that doesn't tell the whole story. Okay. Because a distressed building is going to be at a pretty miserable cap rate because it's not making that much money. And it's probably a little overpriced as well. So generally, you want to look further into the story to figure out if it's a good deal or not, and not just glance at a cap rate. Of course, you have cash flow. You have your gross collected cash flow versus your net. Okay, your gross cash flow is going to not include things like a vacancy factor or lease loss or other expenses as well. There's different more in-depth terms that we don't really have to get into at this time. Debt service coverage ratio, that's how well your building is going to cover your debt cost, your cost of debt, the monthly mortgage payment your building has to make. Most lenders these days want to see a 1.25 debt service coverage ratio. So when you're looking at a building and you're saying, okay, I can buy this for $1 million, I can put $500,000 in renovations into it, and it's going to be worth $3 million. What a heck of a deal. Oh my gosh. Well, hang on. Look at how much it's really making. What's your debt service coverage ratio going to be? Now, if you go to the bank and you say, my building's worth $3 million, I want to pull out a mortgage of 75% of that, 2.3 million, something like that. They'll say, well, wait a minute. Your debt service coverage ratio is 1.0. It's not high enough. Your building isn't making enough cash flow to qualify for that much debt. So therefore, you get less debt. You can't refinance it for as much. Your numbers might be off. So the debt service coverage ratio is an important number to understand, an important calculation to understand when you're determining what a building will be able to refinance for, how much debt a building will be able to handle. Because the bank's not just going to give you as much debt as you want. They're going to see how much net operating income is coming in on the building, right? Net cash flow. And they're going to then give you a loan amount that that you'll have 1.25% times that debt payment, that debt service payment. Okay, so you want to keep an eye on your DSCR when you're calculating how much your building will qualify for on the refinance of the asset. Okay. I also help you determine how much a building could sell for, because your buyer's going to go get a mortgage. So you'll know you can't sell a building at a 1.0 DSCR. You got to know you can sell the building at a 1.25 DSCR. And that tends to be industry standard. Okay, gross rent multipliers. I don't even like this calculation. No one really uses it when you get into the depth with high level commercial assets. Purchase price divided by gross annual rental income. It's a back of the napkin way to determine if you're paying too much for an asset. Again, you could do a pro forma rent and determine what it's worth on the back end once you renovate it and lease it up for fair market value. Or you can do this calculation to determine if the property is overpriced right now for what it's making, right? Net operating income, we touched on that, right? That's your gross revenue minus your expenses, essentially. And due diligence. Okay, due diligence is very, very important. So at the end of the day, our job as operators, and any good operator, if you want to be an active real estate investor, you better be damn good at doing due diligence. Understand everything you have to do your due diligence, not just understanding these terms and digging into spreadsheets. But the more complicated a deal gets, the higher levels of due diligence are required, especially in real estate development. A phenomenal amount of due diligence is required. It'll take 30 days sometimes to complete all the levels of due diligence to just decide if we want to purchase a property, right? Just decide if we want to, what we're going to pay for it. The amount of due diligence when you're buying large scale assets is mind numbing. So you have to understand different levels of it. That's a whole different presentation, right? You have back the napkin calculations that are say, okay, I'm going to dig into the email further, right? I'm going to look at the due diligence vault. I'm going to take an hour and start digging into it, right? And that's your first level of due diligence. You have to be quick at knowing exactly what you want and exactly what indicators are going to indicate to you, hey, this deal might have legs. I might take some time to really look into it a little further and then pass it up to my underwriting team. Then you have different levels of due diligence. You have physical, legal, environmental, and you have to understand every level of due diligence. There's serious costs to certain levels of due diligence, especially as you get further into the purchase of real estate. I've lost $20,000 in due diligence on assets and said, nah, not a good deal. We found something we didn't like. We need to protect our investors' interests. 20 grand down the drain. That's what it costs to run true due diligence on large scale assets. Not saying you should jump into 100, 200 unit buildings, but if you don't have cash laying around ready to do deep due diligence on assets and hire the right professionals, then start with smaller properties like a 6-family in Newark, New Jersey, which is a great way to get started. Value add strategy. Okay, that means what are we going to do to make the building a nicer place to live? Quite simple. We're going to put a gym in. We're going to pave the parking lot. We're going to renovate the units and put in granite countertops and stainless steel appliances and recessed lighting and hardwood floors. And we're going to improve the management of the building. So when something breaks or leaks, we actually show up and fix it. We're going to improve the management of the building by charging a pet fee. We realized 30% of our tenants have a pet, and we're not charging a pet fee. Whoa, we just created $4,000 of additional revenue a month. That creates maybe another $450,000 at the bottom line of your assets. So understand your value add strategy, not just in physical renovations of the building, but improved management, right? Like the pet fee idea, right? So different ways to create additional revenue streams, laundry in the basement, parking, or laundry in the units, right? You might find a building that doesn't have laundry in the units. But it's like a class B asset that really should have laundry in the units because your tenant base would expect laundry in the units. And you recognize, hey, if I put laundry in each of the units plus renovate the kitchens and baths, I can attract a higher quality tenant, and that's going to allow me to improve the rent roll on the property and charge a higher rent for the building and the units. Right. So recognize your value add strategy. What are you going to do to increase the revenue on that building and make it a nicer place to live, and therefore reposition the asset and forced value into it? Then we have general partners and limited partners. There's a lot on this slide. So general partners are the ones operating the deal. That's People's Capital Group here. We call the shots day in and day out. We're professionals at this. We hire professionals to assist us in the management, the due diligence, the underwriting, the value add. Every step of the way, we hire professionals, and we ourselves are overseeing the operation to catch inconsistencies, to enforce efficiencies in our operations, and make sure that the deal we're bringing to our investors is a darn good deal. Okay. Then we have our limited partners. These can be family offices investing 5, 10, $20 million in our opportunities. This could be a accredited investor investing $100,000 from their self-directed IRA. This could be a non-accredited investor investing $30,000 from their savings account, selling some treasury bonds and moving that into our debt fund to earn a high monthly interest, high quarterly interest payment based on a high annual interest rate. So you have limited partners that come in all different shapes and sizes. We do accept non-accredited, sophisticated investors in our debt fund. I'll touch on that at the very end here. Let's get to the next slide. I'm running out of time. Okay, raising capital. I'm just going to talk about this very briefly. Raising capital is the pinnacle of scaling up when it comes to buying incredible commercial assets, apartment buildings, whatever it is you're focused on acquiring in real estate. The bottom line is generally people run out of money pretty quickly when you're buying a lot of real estate. It's a very cash intensive asset class. The story I told you where I refinanced all my money out after a year, that doesn't really happen all that much often. It's much harder to buy, renovate, refinance, repeat. Generally, you can refinance an asset if you buy for a good enough price, you renovate it, you lease it up. Yes, you can refinance a lot of your investment back. But getting 100% of your investment back is much harder in this market. Depending on the market you're in, you may be able to accomplish that. So one strategy is to try to find incredible deals at incredible prices, keep your costs low, buy, renovate, rent, refinance, repeat, try to refinance all your money back out of the asset. That is not that is not something you cannot accomplish. I've done that in a different market environment. We just don't see the deals like that these days, especially if you want to get into larger assets, 50, 100, 200, 400 unit buildings. It becomes less reasonable to steal them on the market because you're playing in a different league. So that brings me to raising capital, right? You generally, to scale up in real estate, you need to raise capital. Capital comes in all different shapes and sizes. You need to understand SEC regulations and follow them as the best you can. And raising capital is really a whole different presentation. But if you want to scale up your real estate investment company, you have to learn how to service investors, how to attract investors, how to be a thought leader in the industry. And you got to know your business better than the people investing in you and with you. You got to know to underwrite assets, understand what an IRR is, a cash and cash return, an AAR. You got to know how to dig into these deals, how to source them, how to negotiate contracts effectively and efficiently. And the most important thing is you need to be transparent to your investors and have a ton of integrity, right? Things don't always go right with your investments, but if you're communicating with your investors what's going on, how you're solving the problems, and then paying them in a timely manner, getting your K-1 tax returns out to your investors in a timely manner, and just servicing your investors on the whole by bringing them great deals, then your investors will tend to repeat invest with you and you can build up from there. But it takes time to raise capital. You can't just run out and raise millions. I mean, maybe you can, who knows? But in my experience, you have to build. Start with smaller investors and build in larger investors. Generally, if you're going to a family office and asking for $10, $20 million, they're going to say, well, what's your track record, right? And if you don't have a track record in successfully repaying investors through real estate ventures, they might say, well, hey, get started with checks around 100,000 or 50,000, friends and family. That's how most people get started. That's how I got started in real estate over a decade ago. Friends and family, invested in fix and flips, hired the wrong contractors, took a year and a half to finish, lost $7,000. Great success, right? But that's the bottom line. You're going to learn from your failures. I learned a whole lot more from that. Since then, I've made my investors lots of income, lots of returns, overachieved our targeted goals. But we learn from our first investments, and our first investments are probably going to be some of the worst investments we ever do. So just recognize there's a learning curve to this business. And therefore, you got to work your way up to raising capital on a large scale and getting into beautiful assets. Okay, so who are we? There's Seth Martinez on the right. Seth focuses on operations here, People's Capital Group. He's primarily running our debt fund. Our debt fund's a small $3 million fund that does fix and flips and buys land. We'll get it approved. We'll sell it to builders. We're buying a 4-unit in Patterson next week for $480. We'll spruce up the building, increase the rent roll on it. We'll sell for about $600,000 quick flip. We plan to flip it in about 90 days. That's what our debt fund does. Investors invest in our debt fund. They earn an interest rate between 8 to 10.5%. The more you invest or the longer you invest, the higher that rate goes. That's me on the left. I'm Aaron Fragnito. I started in 2010, around the same time Seth started. I'm primarily public speaking. I love to speak publicly. I generally am doing about a presentation every other week or so, if not more. We have a podcast with over 155 episodes. I focus on client relations here at People's Capital Group. I'm communicating with over 100 investors that invest with us consistently. We have about an 81% investor retention rate, meaning 8 out of 10 investors reinvest after a liquidity event, like a refinance or a sale of a property. 8 out of 10 investors reinvest with us. That's an important number to understand when you're searching for the right operator to invest in. I went to Rowan University. I graduated with an entrepreneurial degree. And then I went back and just the other year and I taught and wrote a course called, what was it called? Real estate investing for entrepreneurs. Oh boy, I should remember the name of the course I wrote. But the bottom line is it was a lot more work than I thought. And I really enjoyed the experience. And real estate entrepreneurship, that's the name of the course, real estate entrepreneurship. So great experience there. But just we try to give back. We have a Real Estate Investment Association with over 5,500 members in it. So we'll do events about twice a year in person, big networking events. We do building walkthroughs of our assets where we're walking investors through our apartment buildings or properties we're acquiring, explaining how we do it and why we do it and the nitty gritty of repositioning or developing apartment buildings. Together, Seth and I have done over 300 transactions. We've raised about 13 million to date, but that number is aggressively growing here. So we're now focused on working with family offices, registered investment advisors, and we also still work with our retail investors. Retail investors are accredited and sophisticated investors, generally writing checks between $100,000 to $250,000, where family offices are wealthy families, generally investing anywhere from $5 million to $25 million or so. Okay, Seth manages the management company as well. Here's the types of buildings we acquire in the past here and some past performance. So we have a nice building in Patterson, New Jersey here, 25 residential units. That was an old factory that was turned into loft-style apartments there, actually condos that we rent as apartments. We have a targeted 12% cash-on-cash return. The project is ahead of schedule. We could refinance right now, but rates are kind of high, so it's not a smart move right now to refinance, but there's a lot of equity in the asset, and we're looking to refinance that probably next year, depending on where rates go. Last year, we bought this 21-unit in Bayonne, New Jersey. We had about 42 investors participate in this asset. We have a targeted 12% cash-on-cash return for our investors as well in this asset, and that project is on schedule. Bayonne has some landlord-friendly rent control laws, so we like working within Bayonne as compared to Jersey City, where Jersey City is a nightmare repositioning existing assets based on the rent control laws there. Here's another one in Patterson, New Jersey. We've actually done pretty well in Patterson. We're talking with Charles Florio. I'm doing a 190-unit development right now in Patterson, New Jersey, but we got started with an 11-unit here that we refinanced out of and achieved a 24% annualized cash-on-cash return to our investors. Okay, so we bought, renovate, refinanced in 2 years. We did that 3 years ahead of schedule. We achieved a 24% annualized cash-on-cash return to investors. That's a great way to get a big cash payout to your investors and keep them satisfied. Here's our debt fund. This is for non-accredited and accredited investors. This is a good option for investors that want to invest for a shorter period of time, 1, 2, or 3 years. They want to invest a smaller amount or are not accredited. Our debt fund allows investors to get started with $30,000 for just 1 year. Minimum investment amount for the minimum amount of time, which will lock in an 8% annual interest rate. You can also invest up to $1 million or invest up to 3 years. The longer you invest or the more you invest, that increases your interest rate, as you can see here. Now, in the debt fund, investors don't actually own real estate. Where in our equity funds, you do actually own real estate. You get the cash flow, you get the tax depreciation. In a debt fund, you're holding a promissory note. That allows you to know exactly what you're getting when you're getting it. No questions asked. $30,000 invested for 3 years earns a 9% interest rate. You're going to earn 9% on that investment each year. At the end of the year 3, you're going to get back your $30,000. Right? You're a lender. You hold a promissory note. That capital is pooled and then used to fix and flip properties or buy land. We buy share sale auctions. It doesn't matter if those investments don't do well, right? They could do great, they could do poorly. It doesn't affect your return on investment because in this case, you're a lender, you hold a promissory note, you earn an interest rate that's paid out on a quarterly basis, but based on an annual interest rate. It's a good way for investors to get started with us, make sure we have integrity, make sure we perform as planned, as promised, and not invest $100,000, which is the minimum on our equity fund. It's also a good option for people who are not accredited, meaning you have a net worth of $1 million, not including your primary residence, or an income of $200,000 individually, or $300,000 including your spouse. If you are not financially there, then you cannot invest in our equity funds. Right? Our equity funds are only for accredited investors, which is the definition I just stated. Now, that's why we created the debt fund, because we do have a lot of people that are wealthy and successful and have capital to invest, and they want to invest in People's Capital Group. And they've been following us for years. So we have this debt fund option for people who are non-accredited. Now, you do have to be a sophisticated investor. What does that mean? Sophisticated means you have some experience investing in real estate. Maybe you own a home, you own some income properties, you've reviewed investment opportunities before in real estate. You understand what we're talking about. You understand the risks of the investment, the reward of the investment. You have ample income, you have savings. You don't need this $30,000 in your car brakes, okay? It's important that you have ample income and ample savings beyond the $30,000. Generally, you know, if you have $30,000 in your IRA, we really don't call that as qualified. We want to see more like $50,000 or $60,000 in your IRA or whatnot, right? For you to self-direct $30,000 into our debt fund, because we don't want you to be over leveraged or have all your eggs in one basket, right? And not be diversified. So there is a more of a gray zone of qualification for sophisticated investors, but that is a way for people who are non-accredited to get invested in real estate passively and start earning a nice high interest rate as well. And ideally, if you invest wisely in time, you will become an accredited investor and get access to more attractive and more lucrative deals like this one here. This is the next deal that we're looking to essentially move on. We are in phase 3 of our initial underwriting. That means, well, that means a lot of things. So this is for accredited investors only. We just talked about what that means. This is a 420 unit residential deal with the 25,000 square feet of retail space. This is a mixed use asset here with an open air food market on your right, a restaurant there on your left, a 30-foot wide pedestrian walkthrough that goes down to a light rail station in Jersey City, in the Bergen Lafayette section of Jersey City, and of course, a beautiful 18-story residential tower with 420 residential units and state-of-the-art amenities. So an asset like this is a building where we actually, what makes this development work right now, because most of the developments like this are not penciling out today. This works because it qualifies for ESG debt, right? Economic, social, and governance, right? So there's funds out there that are looking for deals like this. Why does this qualify for ESG debt? Well, it has 40,000 square feet of open air space. There's a $7 million community center we're building that we're going to deed to the city once it's built. There's a parking lot we're going to deed to the city once it's built. 40% of the retail space is allocated for minority-owned businesses and women-owned businesses. There's a 5,600 square foot incubator space for entrepreneurs to create and develop new businesses. So because of all the jobs and the social benefits and the community benefits this creates, there's 8% of the building will also be affordable housing. That allows us to qualify for an ESG loan. ESG loans are amazing for borrowers. We can get 100% of our soft and hard costs, our fees, everything, the cost of the land included in the loan, 100%, 0% down. We are also able to get a 5% interest rate locked in for 10 years, right? Go to a bank and ask them for a construction loan to build a $200 million asset. They'll say, sure, 9.5 interest, right? 3.5 points. It destroys the deal, 30% down. Totally different economics. Now, here's the catch. To qualify for this loan, part of the deal is you have to put about $20 million in escrow in a locked ring-fenced account in one of the major 7 banks for about 5 months as they finalize the loan. So you get a term sheet from the bank, then you have to lock up a $20 million deposit for about 5 months. Then the loan is issued and the funds are returned to you, right? So we are working with family offices on this investment. We may open this up to our accredited investor base. So this is something that we're very excited about. Beautiful asset, beautiful opportunity in Jersey City, New Jersey, and that's a mixed-use development. So here's some testimonials from different investors. Most people that invest with us continue to invest and invest multiple times over. Tons of testimonials here, over 100 retail investors, some with over $1 million with us, some with $30,000 with us. But that's it for me today, ladies and gentlemen. There's a link here to schedule a call. You should be able to click on that link. And if you can't, then what I'll do is I'm just going to copy it and put it in the chat. But that's the best way to reconnect and learn about what we have coming up. If you have questions, also kind of more in-depth questions, you want to discuss your investment goals in more depth, then the best way for us to connect is through that link there. I'm trying to find the chat. Oh, here it is. And I'll look at the questions now and let's see what we got here. Okay. Okay, let's go through these questions. Okay, bonus depreciation. Yeah, of course, right? Bonus depreciation, in a sense that's, I guess the term, really there's that's doing a cost segregation study, right? Where you can front load your tax depreciation. I think that's what you mean by bonus depreciation. If it is not, then I would say a CPA would give you a better definition of that. Okay. Okay. Still key investment concepts show. Yep, that's what I meant to put there. Okay, here's a loan guarantor. Interesting. So a loan guarantor is someone that's going to help you qualify for a loan. If you're getting started in real estate, here's a gentleman. Let me open this up a little more. Ethan Gale, right? So he put his information here as a loan guarantor. Now that's a really great person to know, because if you're trying to qualify for a multi-million-dollar loan, you need to have a track record, you need to have a portfolio, and that is extremely important to qualify for a large-scale commercial loan. So what a loan guarantor does, or a KP, a key partner, that'll allow you to, Ethan here will sign on a loan with you. Ideally, he has a good real estate portfolio, he has a large amount of wealth, and that'll help you qualify for the loan. It's probably a good income, owns a law firm. So not only does Ethan offer that, he can also help you create the PPM and the legal documents to properly solicit and raise capital. Okay. And that is a great person to know. So you should take that information down if you want to qualify for large scale commercial debt. And quite frankly, get guided properly from an attorney. You should always work with an attorney to have your PPM and syndication funds forms completed. Okay, these are not documents you can do yourself. Private placement memorandum, PPM, is a legal document. It essentially goes through the risks and rewards and structure of a fund, and it's a very in-depth legal document that you have to have done by an experienced attorney in that space. not just a real estate attorney that closes your fix and flips, but an attorney that is SEC versed and understands how to draft a PPM. It's a different attorney than the attorney we use to close our real estate. Okay, you have a PPM, SEC focused attorney, and then you have your transactional attorneys. They tend to be different types of attorneys most of the time. Okay, John Matthew asked, what is the typical expected time of return for investors' money? Well, it depends. If you're invested in the debt fund for 1 year, you can get your money back after a year. For 3 years in the debt fund, of course, you get your money back after 3 years. If you're invested in an apartment building, it depends. It can be 3 to 5 years. Okay, for that building I just showed you, amazingly enough, because of our debt structure, we are predicting after about 6 to 8 months, investors will receive about 80% of their investment back, which is basically unheard of for a development deal in commercial real estate. So I don't want to spoil my investors, but on our upcoming opportunity, that's probably going to be the structure. Our investors will probably get 80% equity recapture about 6 to, let's call it 12 months into the investment, which is just phenomenal because usually you have to build the building, lease up the building. That can take 3 to 4 years in total to get any type of refinance or sale the asset. So generally, investors have to be patient with equity investments. But that the one we're structuring right now seems to be far more attractive than that. So if someone is investing in a property, you have what percentage are they looking to get as a return? Okay, again, at the debt fund, we're talking about 8 to 10.5% interest rate. Again, this is not a solicitation for funds. This is not tax advice or legal advice. We have to first connect on a phone call. We have to qualify you to invest as a creditor, a sophisticated investor. Our debt fund's a 506B, so I'm in a super gray zone even showing that slide, but it is something that we like to talk about as how our business is structured. It's not a solicitation for funds. It's an explanation of what we do to satisfy our investors' needs. And so essentially, the percentage you're getting on equity investments, we're looking at about a 22% internal rate of return on our ground-up development in Jersey City, New Jersey. 22% internal rate of return. Internal rate of return is a great calculation to determine your return on investment. It takes into account the time value of money, the amount of time your money has been placed at work, and it's important to understand that number when you're underwriting investment opportunities. And if you go out there and start looking for deals, you'll find that generally 22% IRRs are pretty strong. So that's a very strong return. How'd you raise your first funds for a real estate? Helen Tang, friends and family. Friends and family. You need to know what you're asking for before you ask for it. Put together your dream team. Put together who's your attorney going to be. Develop your operating agreement. Tell them if you don't have a deal, at least tell them exactly what you're going to find. I'm going to find single family homes in Essex County, New Jersey that I can buy between 200, 300,000, invest between 50 to $100,000 in renovations and sell them for $400 to $450,000. Here's 6 examples of those types of properties. To do that, I'm going to use this lender. I'm going to use these contractors. I'm working with these realtors and these attorneys. And this is the type of return you should expect. This is the worst case scenario. This is the best case scenario. And these are the this is the amount of money I'm raising, and here's how your funds are secured. Here's how we're going to exit the asset, and here's the return on investment you should expect. You got to know the answers to those questions. If you don't go to raise money. First, do your due diligence, develop your plan, make it airtight, and then even if you don't have a deal, you can start to raise capital by building relationships with people you know generally first, and then branching out from there. It takes time. You got to perform. You got to do what you say you're going to do. And then over time, you can raise money from strangers and larger investors as well. Amy says, I need 4 hotels in Taylor, Texas. My relationship is solid with municipalities. Priority, okay, that's more of a ask here for, it's New Silicon Valley, thanks to Elon, all hands on deck. Okay, I agree. I hear actually, really Taylor, Texas. I'll take a look at that. Okay. All right, looks like Robert Wilburn's asking for a copy of the presentation. That would be great. Charles should have that. But Charles, that's pretty much it here. I believe that's all the questions out there. I put my link, Calendly here. So if you want to schedule a call with me, learn more about our investment opportunities or how we structure our investment opportunities and see if it might be a fit for your investment goals, then click that link in the chat that I put out to everyone, and we can schedule a time to connect on Zoom, and we'll learn more about your investment goals. Hopefully it's a fit. Thanks a lot.
Hey, Aaron, we stop recording.